everyone is going to tell you how to protect your investments during a market crash because they want you to think that investing is super complicated so they can sell you a course or think that they are some kind of expert, but I will. Markets are really volatile right now and people are either scared to start investing or they're pulling their money out because of the uncertainty. However, my investment portfolio has actually been pretty stable the last few months. Let me show you my holdings and my simple strategy. The key to weathering market ups and downs is being diversified. My current allocation has 55% in stocks and shares index funds, 30% in bonds, and 15% in gold. Stocks and shares are by far the riskiest and most volatile investments, but by investing into a global index fund, in my case, the FTSE All World, you are spreading your money across 4,200 companies worldwide that this index tracks. I've specifically chosen this fund by Vanguard as it is a high dividend yield. Dividends are when a company's made enough money to pay their additional profits out to investors. So when you own part of the company by buying a fund, that is you. They pay these out quarterly, then the fund automatically reinvests your dividends for you to buy more of the fund. This is magic because even in market downturns, most of these companies still pay a dividend and you get those reinvested when their stock prices are even cheaper, meaning that when the market goes up, so does your investment value. And you keep getting those dividend payments even when markets are down, meaning that your investment value doesn't wobble much. Next, I have 30% in US government bonds. A bond is when a government or company needs to borrow money. So they issue a bond and you essentially are the lender. So by investing in their bonds, they pay you back with interest. Yes, the returns are lower than stocks. However, bond values tend to stay stable during market ups and downs. The older you get, the higher a percentage of your investments that you should have in bonds. Next, I have 15% in gold, which is historically considered a safe place to park your money, even when everything else is going pear-shaped. Typically, when stock markets go down, gold goes up, although this hasn't exactly correlated the last few years because markets have not been behaving as usual due to world affairs. But the value of gold does continue to go up, so it is a great hedge against the volatility of the other investments in your portfolio. Lastly, I have 10% invested into an AI fund. I've only put a little bit in there as this is the most volatile and risky of my 4 investments, but I would have massive FOMO if I was not getting a bit of the amazing growth of this new technology. And as I choose not to own the S&P 500, it's a great way to get exposure to the highest performing US tech stocks, which prop up that index anyway. Also, I've chosen an ESG fund. ESG stands for Environmental, Social and Governance. This means that they select companies for the fund which adhere to specific standards because I'm an ethical queen.